Let me ask you something. You run a trade or home service business, you're doing real revenue, and at the end of the month, you've got extra profit sitting there. Maybe it's 5,000, maybe it's 10,000, maybe it's 50,000. What do you do with it? Most owners do one of the two things. They leave it in the checking account, ending basically zero, telling yourself you will figure it out later, or they buy a truck, new equipment, or something shiny that feels like progress, but does not actually build wealth. And here's the problem with both of those options. That money sitting in the checking account is slowly losing value to inflation because you're literally getting poorer by doing nothing. And that truck you bought with cash, that is a depreciating asset. And I've seen too many owners buy a truck and then scramble to make payroll 2 weeks later because they confuse a big bank balance with money they can safely spend. And here's the thing, whether you are pulling an extra 1,000 a month or 100,000 a month, the question is not, can I spend this money? But the question is, where does this money need to go first? Today, I'm giving you the exact routing system I use with trades and home service owners by profit level, so you stop making emotional decisions with your cash. And I'll show you how the right tax strategy can free up way more money for the buckets that actually build your wealth. Before we go any further, I need to make sure we're speaking the same language. When I say extra profits, I'm not talking about revenue. I'm not talking about what hit your bank account before you paid your guys, bought materials, covered insurance, or made your truck payment. I'm talking about what is left after all of that. Revenue minus every single expense like payroll, materials, insurance, rent, gas, software, all of it. What is sitting there after the bills are paid? That is profit. And that is what we're routing today. So when I say 10,000 a month in extra profits, I mean you have already handled everything and you have 10,000 that does not have a job yet. If you're not sure what that number is for you, that is a problem we need to fix, but that is a different video because today we're assuming you know your profit number. Let us keep moving. Now, quick CFO reality check. Profit is a scoreboard, cash is oxygen. You can show profit on paper and still be broke in the bank if cash is stuck in receivables or payroll hits on Friday. So before we route anything, here's a 30-second safety gate. Number one, are you current on payroll filings and any tax you collect and hold? Sales tax, payroll withholdings, that money is not yours. Number two, are you current with suppliers and payment plans? Number three, do you have a minimum operating buffer in checking so one payroll run does not wipe you out? At least one payroll plus a couple weeks of core bill. If any of these are a no, your first move is fixing that. Then we route profit. Before I give you the numbers, I need to rewire something in your brain. Most trade owners think about profit like this. Money that came in, bills are paid, whatever is left is mine. And that is backwards. Here's how profitable trades owners think. Money came in, I will route it before I even see it. You're not making spending decisions, you are making allocation decisions. Big difference. Think about it like your dispatch board. You do not throw text at whatever call comes in. You route based on priority, location, and skill level. Your profit works the same way. Open 4 separate bank accounts. I'm serious. Go do this today if you have not. Bucket 1 is tax. Money set aside for income taxes on profits. Most trades owners either oversave here out of fear, throwing 30 to 40% into a bucket and hoping, or they undersave and get wrecked at quarterlies. We can do better than that. Bucket 2 is reserves. Your OCRAP fund, slow season, equipment failure, insurance renewal that hits differently this year. Bucket 3 is growth, money that goes back into the business or make you more money. And bucket 4 is wealth, money that leaves the business and builds your personal net worth. Every month profit hits and you split it across these 4 buckets by percentage. The percentages change based on how much extra profit you are working with. Now, 2 quick definitions so the cards make sense. When I say until target on reserves, it means your funds reserves at that percent until you hit reserve goal in months of overhead. Then you drop reserves to a small maintenance percent and you route the freed up money into growth or wealth. Here's the maintenance rule. Once reserves target is hit, level 1, 10%, level 2, 5%, level 3, 3%, and level 4, 2%. Then reroute freed up percent to wealth by default or growth if you're in a defined 90-day lane. And when you see a range, that means you choose a number in that range based on your quarter plan and based on your tax projections. And as reserves taper at higher levels, a larger portion of profit is intentionally routed to growth and wealth. One more thing, because it matters. Any optimized tax number assumes proactive tax planning, entity optimization, and ongoing CPA oversight. Confirm with quarterly projections so you do not get surprised. Level 1, you're making an extra $1,000 a month. Maybe you're a one-truck operation, maybe you just crossed into profitability. Your goal at this level is simple: stop the chaos. And here's your default split at the 1,000 level. Tax 25%, reserves 55% until target, growth 10%, and wealth 10%. Now, even at this level, there are moves: tracking your mileage correctly, capture every legal deduction, timing some expenses right. I've got a video on the top deduction trade owners miss. Link is in the description, because even saving 5% here means more going into your reserve bucket when you actually need it. And with basic cleanup, your optimized target can look like this: tax 20%, reserves 55% until target, growth 15%, and wealth 10%. Same money, better routing. Let me explain why reserves are so heavy at this stage. Because early stage profits are fragile. High reserve routing is intentional. You do not have a cash buffer yet. One slow week, one truck repair, one insurance surprise, and you are scrambling. And at 1,000 extra, your first job is building 1 month of overhead, and then 2 months. What is overhead? It's rent, insurance, minimum payroll, software, vehicle costs, whatever you have to pay, even if 0 jobs come in. Now, that growth money at this level, do not hire anyone. You cannot afford a person yet, but you can afford tools that can save you time: call tracking, so you can know which marketing actually works; scheduling tool that does not make you want to throw away your phone; getting your books cleaned up so you actually know your numbers. And on the wealth side, even at this level, I want you to build the habit. Automate it into an index fund. The amount does not matter yet. Habit matters. And here's the trap at this level: you want to buy a truck. I get it. Your current one has 180,000 miles and it makes weird sounds. But here's the truth: you are not truck poor. You're cash buffer poor. Fix that first. Now, let us move up. Level 2, 10,000 a month extra. Now you have got a real business, multiple types, steady pipeline, probably some growing pains. Your goal at this level is to buy back your time, systemize operations, and start building real wealth. Here's the default structure at the 10,000 level: tax 30 to 40%, reserves 20% until target, and growth and wealth split the remainder 50-50. That is why on the card you see growth and wealth landing about 20 to 25% each. They split the remainder 50-50 once tax and reserves are set. But here's where it gets interesting. At 10,000 extra per month, you are now in the zone where tax strategy starts making a serious difference. We can often drive that tax bucket down close to 20%, but only if the projections support it. S Corp election, that is a big one at this level. If you're not sure whether you should be an S Corp, I made a whole video breaking down exactly when it makes sense and when it does not. I'll link it below. But the short version, at 10,000 extra monthly, you are almost certainly leaving money on the table if you're not at least evaluated it. Now, here's the money math. If you drop your tax set aside from 40% to 20%, that is $2,000 per month over a year. That's $18,000 to $24,000 redirected from the IRS to your future. So with good strategy, your optimized routing at this level often ends up like tax 20%, reserves 20% until target, growth 30%, and wealth 30%. Now, reserve at this stage, seasonality is real. If you're HVAC, January is slow. If you're in landscaping, winter exists. Your reserve target is now 2 to 3 months of overhead. This is your winter it's coming fund. Now, growth. You've got real reinvestment money here, but I do not want you spreading it thin. Pick one lane for 90 days. Lane A is buyback admin time, part-time office help or VA, answering service for overflow, dispatcher support, even 15 to 20 hours a week. Every missed call is missed revenue. If you are the one answering phones while you're under sync, you're leaving money on the table. Lane B is marketing you can measure. Google local service ads, search ads for emergency plumber near me type keywords, retargeting. The rule is simple. If you cannot tie it directly to booked job, it is not reinvestment. It is hope. Hope is not a strategy. Lane C improves your close rate. Better estimate follow-up, text plus email sequence, financing options for bigger jobs, call scripts for your team. Most trades business close 30 to 40% of estimates. Getting to 50% is like adding another marketing channel for free. And now wealth. Now we're actually building something. And this is where tax strategy doubles down. Retirement accounts. The right retirement setup does not just build your future. It reduces taxable income today. And that is a double win. Real estate at 10,000 extra only if you already have reserves, clean book, and you can handle one property without it distracting you from operations. Best bet, boring long-term rental with property management, not Airbnb because your buddy did it. Now let us talk about level 3, 50,000 a month extra. You have built something very serious. You have multiple crews, maybe multiple locations, real infrastructure. You're also probably working more than you want to be. And your goal at this level is to scale without breaking quality, protect what you have built, and aggressively diversify outside the business. Here's the quick reason the remainder feels bigger than level 2. Reserves are lower now, so more profit is intentionally routed to growth and wealth. And here's the default structure most owners live in without proactive planning. Tax 30 to 40%, reserves 10% until target, and then the remainder is split with the wealth bias. And that is why you see growth around 23 to 27% and wealth around 28 to 33%. And I'm gonna say this, that 40% tax forever mindset makes me cringe because with proactive planning at this level, we're often targeting 25%, and that is not a typo. Think about what that means. If you're keeping an extra 10 to 15% of 50,000 every single month, that is 5,000 to 7,500 more grow into growth and wealth. Over a year, that is 60,000 to 90,000 you are redirecting from the IRS to your future. At this level, if you do not have a tax strategist, not just someone who files your returns, but someone who actually plans with you, you're almost certainly overpaying. Link is in the description. So with planning, your optimized routing on the card looks like this. Tax 25%, reserves 10% until targets, growth 29%, and wealth 36%. Reserves at this level, your target is 3 to 6 months of overhead. Why so much? Because at your size, the hits are bigger. Equipment failures are more expensive. Slow seasons hurt more. And you're not just protecting yourself, you're protecting your team's paychecks. Now, growth at this level, this is where you stop being the firefighter and start building the machine. Priority 1 is operations capacity. Hire people who remove you from a day-to-day. Office manager or full-time dispatcher, service manager or production manager, someone who owns scheduling and crew utilization. Priority 2 is quality control. In trades, profit dies in callbacks and warranty work. If 10% of your jobs have callbacks, you do not have a revenue problem, you have a quality problem. So investing in training programs, checklists, and SOP, and someone who audits job quality. Priority 3 is systems. CRM with real pipeline visibility, estimate follow-up automation, weekly job costing dashboard, accounts receivable discipline. Stop letting customers float you. Priority 4 is marketing engine, content and reviews machine, referral partnerships, paid ads that actually scale with tracking. And wealth at this level, now you're building a real portfolio. And here's a simple framework. 60 to 70% diversified index funds, 20 to 30% real estate, 0 to 10% opportunistic plays, only if you have a real process. Best real estate for trades owners at this level, long-term rentals with property management, small multifamily for simplicity, or warehouse shops. Real estate if it supports the business and you separate entities correctly. And now let us go to the top level. Level 4, 100,000 a month in extra profits. You're not running a small business anymore. You're running a company. Your goal is to protect the empire, allocate like a CFO, and plan your exit. The default advice you will hear is just plan for 35 to 45% taxes. That makes me physically uncomfortable when people have the capacity for real planning. With the right strategy, we're often targeting 20 to 28%, sometimes around 20 in aggressive situations, but only if projections support it and your entity structure and owner comp are dialed in. At this level, strategies get more sophisticated. Cash balance plans, defined benefit structures, entity layering, charitable strategies if that aligns with your values. The playbook is deep. The math is simple. 15 to 20% savings on 100,000 monthly is $15,000 to $20,000 every month. That is $180,000 to $240,000 a year you're either giving to the government or redirecting to your wealth. At this level, if you do not have a strategic tax team, I mean a team, not just a CPA who files returns. You need one yesterday. Link is in the description. Now, routing at this level looks like default tax 35 to 45%, reserves 7% until target, growth 15 to 18%, take wealth, whatever is left. Optimized tax 20 to 28%, reserves 7% until target, growth 15 to 18%, you can pick, and wealth whatever is left. Notice that wealth bucket. At this level, you should be pulling significant money out of the business and diversifying. You have already proven the business works. And now it is about building wealth that does not depend on you showing up every day. Here's what changes at this level. Your biggest risks are not marketing or tools anymore. Your biggest risks are compliance and lawsuits, wrong entity structure, partner and employee issues, acquisitions gone wrong, taxes that could have been planned. Growth at this level looks like executive leadership, ops leader, controller, GM. It can look like acquisitions, buying a competitor, buying route books, buying smaller shops. It looks like internal control, fraud prevention, purchasing discipline. It looks like customer experience system because your brand is your moat. Wealth gets more sophisticated. 40% liquidity and safe yield, dry powder. 30% market investing, diversified. 20% real estate, managed and scalable. And 10% private deals, only with a real team. At $100,000 extra, you're not just building wealth. You are building optionality, the ability to say no, the ability to exit when you want to, not when you have to. 4 things I see trade owners do that wreck their finances. Number 1, buying trucks as a reward. A truck is not a trophy. It is a depreciating asset that should come after reserves, not before. Number 2, hiring before you have the systems. Adding people to chaos just gives you more expensive chaos. Number 3, no reserve fund. Seasonality does not care about your cash flow projections. And number 4, overpaying taxes because you think that is just what it costs. No, it's not. Strategy matters. Every month, do these 5 things. Route profit into your 4 buckets by percentage. Check your reserve target 1 to 2 months at the 1,000 level, up to 3 to 6 months as you scale. Stay in one growth lane per quarter. Stop chasing shiny objects and automate your wealth investing so it happens without you thinking about it. Review your pricing and margins, especially labor and materials. That is it. Simple system, massive result over time. All right, here's what I want from you. Drop a comment with your level, 1,000, 10,000, 50,000, or 100,000, and tell me your trade. HVAC, plumbing, electrical, roofing, remodel, restoration, pool, pest, landscaping, whatever you do. I'll reply with a single best reinvestment move for your specific stage and trade. Now, if you have watched this and thought, I'm definitely overpaying in taxes, you're probably right. Most trades owners are. I link a video below that breaks down the biggest tax mistakes I see, and if you want to talk through your specific situations, there's a link for that too. Subscribe if you want more content like this. I'll break down exactly how to execute each of these strategies in upcoming videos, and I'll see you in the next one.